BigBear.ai Holdings Inc., trading under the ticker BBAI on the New York Stock Exchange, is currently trading at 6.285 USD, which represents an intraday increase of 0.115 or 1.86% as of 1:06 p.m. EST on this Friday, January 16, 2026. While a nearly 2% move might seem like a standard day at the office for a high-beta AI name, the underlying mechanics driving this price action suggest something far more structural than a simple sector rally. Most retail traders looking at their Robinhood app or scrolling through investing sites see a small-cap company riding the coattails of giants like Nvidia stock or Apple stock, but the reality is that BigBear.ai just fundamentally altered its survival DNA in the last 48 hours. The immediate development that the broader market has yet to fully price in is the total elimination of a massive debt overhang that has haunted this company since its public debut. On January 14th, just 2 days ago, BigBear.ai announced the full conversion of its 6% Convertible Senior Secured Notes due in 2029. We're talking about $125 million in principal that was essentially wiped off the liability side of the ledger and shifted into common stock. For those of you managing an individual brokerage account or utilizing self-investing strategies, this is a textbook case of a clearing event. The tension between the expectation that Big Bear would eventually be crushed by its debt service and the reality that they now have a fortress balance sheet with only about $17 million in note-related debt remaining is the primary reason the stock is showing this resilient green hue today. When you look at the intraday chart, the volume today is significantly higher than the 10-day average, indicating that institutional players are likely re-entering positions now that the insolvency risk has been virtually removed. If you are using an interactive brokers platform to track deep book data, you'll notice a tightening of the bid-ask spread compared to last week, which suggests the volatility that comes from distressed trading is giving way to more stable long-term accumulation. People often compare this company to Palantir, but that comparison has always been a bit of a trap. The common belief is that BigBear.ai is just a smaller, less successful version of PLTR. But the reality is that while Palantir focuses on being an all-encompassing operating system, Big Bear has pivoted into a highly specialized niche of decision intelligence for national security and supply chain logistics that is becoming increasingly automated. If you are using Fidelity Investments or SoFi Active Investing to build a diversified tech portfolio, you have to ask yourself, why did BigBear.ai choose this moment to force the debt conversion? The answer lies in their recent acquisition of Ask Sage. By bringing a generative AI platform into their ecosystem that already serves over 16,000 government teams, they've transitioned from being a labor-heavy consulting firm into a software-heavy recurring revenue model. This is the shift that transforms a $6 stock into something much larger, but it requires a clean balance sheet to execute. The market expects another year of losses, but the reality is that their current ratio has surged to over 3.0, meaning they have more than enough cash to fund operations without returning to the capital markets for a dilutive raise anytime soon. Speaking of the market at large, we are seeing a strange divergence. While Tesla stock and other megacaps are dealing with shifting interest rate expectations, small-cap AI plays like BBAI are beginning to trade on their own specific catalysts. If you are checking your Fidelity mobile app or looking for investment help on how to play the mid-quarter lull, the volume spikes in BBAI's option chain for the February and March expirations are telling a story of anticipation. There's a cluster of call buying at the $7.50 and $8 strikes. This suggests that the smart money isn't just looking at today's 1.86% move, they are betting on a post-debt conversion re-rating. Comment below how many shares of BigBear.ai you currently hold in your portfolio, and if you think the recent debt conversion is enough to push it past the $10 mark this year. To understand why this move today matters, we have to look at the recent partnership with the Kraft Group and the New England Patriots. This isn't just a marketing stunt. The Kraft Group owns International Forest Products, one of the largest traders of forest products in the world. BigBear.ai is implementing their AI-enabled supply chain insights to optimize global logistics for them. This moves the needle because it proves their tech works outside of a Pentagon bunker. If you are using Schwab Intelligent Portfolios or SoFi robo-advisor services, you might not see these individual names frequently. But for those who prefer online investing with a more hands-on approach, these commercial wins are the leading indicators of the margin expansion story that the bulls have been screaming about for 3 years. Now, let's get into the nitty-gritty of the business model for those who are new to the name. BigBear.ai operates through 3 primary modules: Observe, Orient, and Dominate. Observe is about data ingestion, taking the massive, messy piles of information that government agencies collect and making sense of it. Orient uses machine learning to find patterns in that data, and Dominate provides the visual dashboard that allows a general or a CEO to make a decision in real time. This is essentially the brain of a modern operation. In the past, the knock on Big Bear was that their gross margins were too low, hovering in the 20 to 30% range compared to the 80% margins you see at a pure software company. The expectation was that these margins would stay low forever because the work was too custom and labor-intensive. But the reality is that their productization strategy is starting to bear fruit. By using the technology they built for the Army and packaging it into repeatable software like Veriscan and Conductor OS, they are reducing the need for expensive engineers to sit and code for every single new client. If you are doing self-investing on a Robinhood stock trading account, you might have missed the fine print in their Q3 report, but their R&D spending is actually staying flat, while their revenue is projected to grow between 12 and 15% in 2026. That is the definition of operating leverage. It means every new dollar of revenue is costing them less to generate than the previous dollar. We also need to talk about institutional activity. When a company is this small, with a market cap around $2.7 billion, a few big moves by hedge funds can send the stock screaming. Recently, we've seen a decrease in transactional activity from retail sentiment on certain investing sites, which usually signals a period of consolidation before a breakout. According to recent filings, Fidelity Brokerage and other major institutional holders have maintained their positions, which is a vote of confidence considering the volatility the sector saw in late 2025. If you are looking for investment help or trying to invest online in names that aren't just the Magnificent Seven, you have to look for where the institutional floor is. For BBAI, that floor seems to have established itself firmly around the $5.50 to $6 range. The technical setup on the Interactive Brokers trading charts shows a bullish cup and handle formation that has been building since December. Today's push towards $6.30 is testing the upper resistance of that handle. If it breaks through $6.50 on high volume, there is very little overhead resistance until the $8 level. This is why the timing of the debt conversion was so critical. By removing the risk of a forced liquidation or a debt spiral, management has cleared the path for the stock to trade purely on its fundamentals. If you are managing your Fidelity IRAs or Fidelity Wealth Management accounts, you know that risk mitigation is just as important as growth, and Big Bear just mitigated their biggest risk. Let's address the elephant in the room, the competition. You've got Palantir, you've got C3.ai, and you've got the massive consulting firms like Accenture and Booz Allen Hamilton. The common market narrative is that Big Bear is stuck in the middle, too small to compete with Accenture on consulting and not enough of a platform to compete with Palantir on software. But the reality check is that Big Bear is winning contracts precisely because they are nimble. Their 93% new business win rate and 100% recompete win rate are numbers that the big boys can only dream of. When the Department of Defense is looking for a specific solution for unmanned naval operations, they don't always want a generic platform. They want a mission-ready tool that can be integrated into existing systems. That is Big Bear's sweet spot. If you are using Fidelity Trading Platform or the SoFi Trading Platform to execute trades, you should also be looking at the macroeconomic pressures. We are in an environment where government spending on disruptive defense tech is at an all-time high. The One Big Beautiful Bill, as some call it, has allocated hundreds of billions to the DHS and DoD for exactly the kind of predictive analytics BBAI provides. While some investors are worried about lumpy government revenue, the reality is that these contracts are often multi-year and extremely sticky. Once an agency integrates Big Bear's Observe module into their data flow,